So I've posted numerous videos explaining to you folks how a portfolio that is heavy on the bond side, for example, 72% in a bond index fund and 28% in an S&P 500 index fund, is super low risk, is 100% liquid, and it easily and consistently beats what you'll ever get with an index annuity. But let's just say that you've chosen to ignore everything that I presented, and now you're thinking to yourself, should I put my money into this annuity that is being pushed on me, or should I put it in a certificate of deposit? Well, in this video, I'm going to show you why index annuities don't even hold up to CDs. That's right, lowly CDs are better. And a lot of people are shocked by this. They went to some commission-hungry advisor who led them to believe that index annuities are going to give you stock market-like returns with no downside risk. Sounds too good to be true. It is too good to be true. According to a study by Advantage Compendium, and before I even get into the study, according to Advisor Perspectives, Advantage Compendium is led by someone who operates a website and service that provides information to the insurance industry, mostly to help promote the sale of index annuities. Do you think this guy is biased? Well, it doesn't even end there. This guy also co-authored a study called Real World Index Annuity Returns, which was fatally flawed in many ways, not the least of which was that instead of gathering annuity contracts from actual customers, they asked insurance companies to provide them with contracts. This would be like the equivalent of asking O.J. Simpson to handle the gathering of evidence regarding those two Brentwood murders. So right off the bat, we have to ask if the study is at all reliable, and if not, it has probably been fudged to the upside. So keeping that in mind, CDs still came out looking really good. According to this study, from September 2005 until September 2010, the average index annuity returned only 3.89%. That's only slightly better than the 3.81% you would have earned with a 5-year CD. And a taxable bond fund would have earned 5.1%. And there's two more things to consider that favor CDs. Most index annuities have surrender penalties of about 7 to 10 years. So what happens when you get a 10-year CD instead of a 5-year CD? Yes, of course, you get a higher rate of return. So right there, you have to figure that CDs are better. Also, regarding this short 5-year time period of the study, insurance companies have the right to change the rules of the game in the middle of the game. They lower caps so that you get lower returns as the years go by. Chris Wang did a review of the Allianz 222 index annuity, and they lowered S&P 500 performance caps from 3.75% down to 3.5%, down to 2.5%, most recently down to 2.25%. According to Chris, with all index annuities, you can expect returns of between 1% and 3% when held for at least 10 years. So basically, William Reichenstein was right when he said in this Bloomberg article, even with interest rates near record lows, CDs may still do better than index annuities. And whether CDs will provide a higher return on investment or a little less, do you really care about splitting hairs when you compare the two side by side? There is no contest when you look at surrender penalties. Take the Allianz 222, for example. In the first 3 years, if you need to get your money back and surrender the contract, if you invested $100,000, guess what? You're only getting $90,000 back. How much do you get back with a CD? $100,000. You only lose the interest. There's also no contest when it comes to bank default versus insurance company default. CDs are FDIC insured. Nobody has ever lost a dime of FDIC insured deposits. Annuity guarantees, on the other hand, are only backed by the claims-paying ability of that one single insurance company that writes the contract. Now, insurance salesmen are quick to tell you that each state has a guarantee fund, but what they don't tell you is that in the event of a systemic failure of insurance companies, that fund may become depleted. And states have limits on the dollar amounts that they'll cover, and California only pays 80%. So basically, if you live in California and the insurance company that writes your annuity contract goes bankrupt and it's up to the guarantee fund to bail you out, you automatically lose 20% of your money. Isn't that wonderful? Are you starting to understand why Bloomberg says CDs are better? Now, having said all this, should you run down to the bank and put all your money in CDs? For most people, no way. Putting your money in CDs is not investing. Putting money in CDs or annuities is like hiding under the covers. For most investors, if you don't take some risk and you're taking out 4% per year, you're going to run out of money or have a diminished lifestyle because of inflation. One of the more important decisions you make as an investor is deciding how much risk you should take. And for most people, this simply means deciding on a bond stock allocation ratio. Most people don't put any investment money in CDs, and most people certainly should not put money into annuities. Annuities are sold to unsophisticated investors by commission-based salesmen. So if you need help on formulating a game plan, then hire a fee-only fiduciary on a one-time or one-task basis, or go to a light advice company like Vanguard, or use a so-called robo-advisor or robot advisor, many of which are free.